Hey everyone, welcome back to the channel. Today, we're diving into one of the most talked about high-income ETFs in 2025, ULTY, the YieldMax Ultra Option Income Strategy ETF. Some investors are calling it a cash flow machine, while others say it's a NAV-decaying time bomb. So, should you worry about ULTY in 2025? Let's find out. Make sure to hit that like button and subscribe if you enjoy deep dives into ETFs, dividends, and high-yield investing. Let's jump right in. ULTY, short for the YieldMax Ultra Option Income Strategy ETF, launched in early 2024. It's an actively managed ETF that uses covered call strategies on multiple high-volatility US stocks. In simpler terms, the fund owns stocks and sells call options against them to collect premiums as income. Now, here's what makes it unique: instead of focusing on one stock, like TSLY or MSDY, ULTY spreads its option strategy across 15 to 30 stocks, names like Palantir, Coinbase, Rocket Lab, and Robinhood. By doing this, ULTY generates consistent option premium income, but at the cost of capping its upside potential. The expense ratio: roughly 1.3%, higher than your typical index ETF, but expected for an active options strategy. And here's the headline that's attracting attention: a yield that's reportedly over 80%. Even above 100% annualized, depending on recent payouts. Sounds insane, right? Let's unpack that next. In 2025, investors are obsessed with income. After 2 years of elevated interest rates, people want cash flow, and that's where ULTY shines. The fund pays weekly distributions. Yes, every single week. That means 52 payouts per year, which gives the illusion of a dividend machine. But here's where it gets interesting. Analysts estimate forward yields north of 80%, that's massive. However, that doesn't necessarily mean you're earning 80% in profits. A large chunk of those payouts could include return of capital. Basically, you're getting some of your own money back. Assets under management have ballooned, crossing billions within a year of launch, showing just how hungry investors are for yield. But with big returns come big risks. Now, let's talk about what you should worry about. The first major concern is NAV decay, or the slow erosion of the fund's value over time. Here's how it happens: every time ULTY sells call options, it limits its upside. If the underlying stocks rise sharply, ULTY doesn't capture those gains, it only keeps the option premium. But if those same stocks fall, ULTY still absorbs the losses. That imbalance slowly eats away at the NAV. It's the trade-off for high yield. Second, return of capital. When ULTY pays out more than it earns in premiums, it has to return part of your invested money. That's not sustainable forever. Third, the holdings themselves are high volatility tech names. Stocks like Coinbase, Robinhood, and Rocket Lab can swing 20% in a week. That means massive risk exposure underneath that juicy yield. And finally, the expense ratio. At 1.3%, ULTY is far more expensive than passive dividend ETFs like SCHD or VIG. Put it all together and you've got a fund that can produce monster income but at the cost of long-term capital stability. So, how should you analyze ULTY? Here are the key metrics to watch. 1. Key cap emoji, distribution breakdown, check how much is genuine income versus return of capital. 2. Key cap emoji, NAV trend, is it holding steady or sliding every month? 3. Key cap emoji, volatility exposure, what stocks are they writing calls on, and how risky are they? 4. Key cap emoji, SEC yield versus distribution yield, the SEC yield shows the real underlying income. 5 keycap emoji, expense ratio impact, that 1.3% fee chips away at total returns. Now, compare that to peers like JEPI and JEPQ. They offer lower yields, around 8 to 10%, but they're far more stable. ULTY, on the other hand, is the high-octane version of an income ETF. Think of it like driving a race car, thrilling, but you'd better know what you're doing. So, should you worry about ULTY this year? Honestly, yes, at least a little. If you're expecting it to act like a safe income fund, you'll likely be disappointed. The yield is enormous, but so are the risks, NAV erosion, volatility, and capped upside. However, if you fully understand the strategy, and treat ULTY as a speculative income play rather than a long-term core holding, then it might have a small place in a high-risk portfolio. Use it for diversification or short-term yield enhancement, not for retirement stability. My personal take. In 2025, ULTY is like playing with fire, fascinating to watch, but dangerous to hold too long. So yes, you should worry, but more importantly, you should understand what you're buying. If you found this breakdown helpful, hit that like button and subscribe for more ETF insights. I'd love to hear your thoughts in the comments. Are you holding ULTY, or steering clear? Thanks for watching, I'll see you in the next video. Hit that like button and subscribe. Your participation is invaluable, and together we can build a community of informed investors. Stay tuned for our next episode where we will dive deeper into the world of ETFs and provide you with the insights you need to make informed decisions.